I've just started the recording. And we're going to wait just a few minutes. My apologies to people that are listening to this at a later time. We're going to wait a few minutes for people to arrive, and then we're going to go over a couple of announcements, and then on to our guest speaker. Just out of curiosity, those of you that are looking at my screen, can you see the my, my, can you see the window that I'm dragging around right here, the participants window?
Are you talking to me?
Oh, just to anybody in the group that would like to answer. Can you see the participants window right here? I want to make sure that we try and keep it off the video.
No.
Okay, perfect. All right, as people are joining, and they're going to continue to join for the next 4 to 5 minutes, we'll start around 12:05. And the recording has started for those of you that are just joining us. Welcome to the Real Estate Investment Education Club here at Intel, where we bring in great guest speakers every week. This week, Jason Hartman is going to be joining our previous Speakers Hall of Fame, which is on our SharePoint site. You can go there by just looking for Real Estate Investment Club on the Intel internal SharePoint site, and you'll get to it. We've got a video over here to walk you through how to subscribe to event notifications. And then over on the side, if you want to find out where we're having conversations on Yammer, or where our video recordings are located, or any of our upcoming meetings, which are actually now booked out all the way into April, you can look here. So the first thing that I want to announce is that we've got our discussion club coming up at 3 o'clock Pacific time today. And it's just going to be a half-hour discussion club. The discussion clubs, like always, are community-driven. There's no set agenda. There's no guest speaker. The topic of the day is LLCs. And so if you'd like to come and be a part of that, just join, and you can tell us your LLC experience or your LLC strategy. It's just an open community discussion time. The second thing that I want to announce is that we're starting to take testimonials. Not testimonials, but I've had a lot of people, probably 2 or 3 dozen people come to me and say that they've learned a lot from this education club, and that they've even bought a house, an investment property, based on the people that they've heard speaking in this club. So if you are one of those people and you really have enjoyed what you've seen here, honestly, it makes my day. And I think that having a little site on our internal SharePoint where people can share their experiences would be great. So if you want to share your experience with the Real Estate Education Club, then contact me or one of the people that's on our leadership committee, and we'll set it up for you. All right, if you're brand new, I do want you to take note of our Speakers Hall of Fame. We've got over a year's worth of speakers happening every week here. Everybody from Kathy Fettke, a well-known commentator. We've had Courtney Buck. He's an ambassador from the CDC to the WHO. We have people syndicating parking lots, syndicating buildings, buying investment homes, buying farms in Colombia and running them. So just a host of people here, lots of great information, and take advantage of that. And soon, Jason Hartman will also be down here on the bottom as well. So let me introduce Jason really quickly. Jason is the host of the Creating Wealth podcast, a podcast that is heard in, if I got the number right, I think you said it's over 180 countries. And he's owned properties in 11 states and had hundreds of tenants. Jason, welcome to the group.
Hey, thank you so much, Daniel. I really appreciate it. It's a real honor to be here. And, have to say, I use your products all the time. Intel inside, right?
Yep.
Been following this storied company for decades, and just love the story. It really is one of the major players that kicked off the whole Silicon Valley movement. So it's a real pleasure to be here. I'll go ahead and share my screen. hopefully you all see that okay. Maybe you can confirm now the video.
I can see it.
Okay, great. The video.
Oh, and Jason, I'll monitor the chat window for you. And
Okay.
so people, you can put questions there for Jason.
Great, thanks. And yes, I'm happy to answer any questions, of course, and help with anything. Let me just get the video back on the same screen. Yes, there is a lot going on in the world, a lot going on in the economy nowadays. It is, the Chinese have a saying, may you live in interesting times. And I don't believe they necessarily meant that in a good way. They just, meant to say that was an interesting times, challenging times. And these are definitely very strange times indeed. What I hope to do today is talk to you about how you can navigate these times and how you can not only survive them, but thrive during these times. Because as we see, this economy is very, very uneven. And some people are doing extremely well and others are struggling. And, the best thing we can do is to be on the side where we're doing as well as we can. And it's really just a pleasure to be here. And I hope to give you some insights into the market and how it is. There is way too much to talk about, to fill in a 1 hour meeting. But on my podcast, I've got several podcasts and over 6,000 episodes. And like Daniel said, listeners in 189 countries. So these are deep subjects. They take a long time to talk about. But hopefully in the next hour here, I can just give you a nice overview, some actionable insights that you can use to just improve your investments, your portfolio, and just to have more peace of mind and more growth in that. So first of all, let's just look at a couple of things that are going on in the housing market and the economy in general. And if you look at housing, this will not come as a surprise to probably anybody in the meeting here, but it is surprising to some, because try and think back to the thoughts you had and the things you heard on the news back last year in maybe March of last year, right? March, April, May of last year, just over a year ago. It was pretty gloomy. And a lot of people were talking about a housing market crash. A lot of people were talking about a general crash in the economy. And, these predictions turned out to be fabulously wrong, fabulously wrong. And one of the reasons these predictors and prognosticators commonly get it wrong, and, it's not necessarily their fault that they get it wrong. It's because of government and central bank intervention. And we just never know for sure how governments and central banks will intervene in the economy. If we looked at things and just left the economy alone and the housing market alone during this time, we would have probably had a very significantly different market than we have today. But what we have today is nothing short of crazy, phenomenal. I've been doing this for a long, long time. Either myself or my companies have helped nearly 10,000 people buy properties. And so that's a long career. And I started out my career in Southern California. I was a traditional real estate agent, selling properties in high-end areas like Irvine and Newport Beach, California. And then I purchased a real estate company. I later sold it to Coldwell Banker. That was 16 years ago. And then I got into the investment side of the business, which was always my first love and my reason for getting into real estate. I like to say that income property is the most historically proven asset class in the entire world. And the reason that is true is because it just has really unique characteristics. And those characteristics are unmatched in any other asset class. We earn our return in a lot of different ways when it comes to income property. It's not just the one-dimensional investment where you buy low and sell high, right? That's a non-dividend paying stock. It's precious metals, it's cryptocurrencies. Those are the buy low, sell high game. But our game is multidimensional. It's buy low, sell high, get cash flow, get tax benefits, use leverage, and take advantage of something I will share with you today, a trademark term of mine called inflation inflation-induced debt destruction. I know that's a mouthful, but it's pretty magical, and I think you'll like what I'm going to share with you about that today. So in just looking at the housing market, if we look at a recent stat here, pending home sales up 32% from a year earlier. And so that's the home sales volume, right? Sales volume. And then on this next chart, we look at home prices, which are, of course, different than volume. But one thing I do want to say on volume, now prices are up and volume is up. Volume would be up significantly more if there wasn't a major shortage of housing inventory. There is a substantial shortage, and a lot of people are predicting a bubble and saying, when will the bubble pop? And there are good reasons to ask those questions because nothing goes on forever. But, and by the way, I'm about to say the famous last words of any investor, so I do not say this lightly. And here are those famous last words. This time, it's different. And it truly is different this time. I mean, it's very different. If we look back 13 years ago to the beginning of the Great Recession, we went into that market with higher interest rates, very low housing affordability, a massive amount of mortgage fraud and what we call liar's loans, where people were qualifying for home loans that should never have been buying those properties. And many of those people got adjustable rate mortgages back in 2002 and right around that time, give or take. And those were either 3-1 arms or 5-1 arms, meaning that they were fixed for 1 year, and then they were actually fixed for 3 to 5 years, and then they would adjust in one particular year when that adjustment time came up, and people would get what we call payment shock. And so we don't have any of this time around. So it really is very different. And by the way, I will make a pretty bold prediction to you. Don't let me forget that. If I don't make that prediction today, during my talk, be sure you ask it as a question toward the end, because I don't want to forget to give you this prediction. It's pretty significant. Okay, so home prices up 15%, another high. And here's the mistake a lot of the commentators and predictors of doom and gloom and bubbles make. When you hear these people talking on CNBC, you read articles in the news media, you hear them everywhere, right? They say, well, home prices are now past the prior peak, and look what happened last time around. When home prices peaked out, we had a recession. Well, they are measuring the wrong thing. The vast majority of home buyers buy based on a payment, not a price. And they should be comparing mortgage payments and adjusting them for inflation and, of course, interest rates, which naturally occurs, rather than just looking at home prices. Looking at home prices is kind of meaningless, because if you're paying 7% interest or you're paying 2.5% interest, that is a significant difference in monthly payment. So here's one of the things you should know. If you adjust for interest rates, prices in terms of the median price home, and inflation, the mortgage payment today is actually lower than it was 14 years ago. That's pretty significant. And that's why the market continues to boom. And there is this massive seller's market where there are multiple offers on properties, where properties keep going up in price. It's because the payment is lower, and the vast majority of people, almost all of them, are buying the house based on the payment, not the price. Who cares what the price is? It's what is the monthly payment. That is what really matters. So unless you're a cash buyer, then of course the price matters, but most people are not cash buyers, and that's why the payment matters. So record high prices, record low inventory, record multiple offers. And one of the things I talk about on my podcast quite a bit is something I invented 16 years ago called the Hartman Risk Evaluator. And the Hartman Risk Evaluator basically takes into account a very important set of metrics, and that is the ingredients for a house or an apartment building. And if you look around, I'm in my house, and you look around and you think, what are the ingredients of this? What makes this property? Well, of course, it's lumber, concrete, petroleum products, energy, labor, glass, steel, and many other items, right? So there's copper wire running through the walls. There are all these petroleum products in the insulation and the roofing materials all over the place, lumber, concrete, all of these commodities, right? So when people say, do you love real estate? Actually, I don't love real estate that much. What I love is being what I call a packaged commodities investor. And one of these commodities that is going up in price dramatically, among others, is lumber. So looking at the chart on the screen, you see lumber prices, and they are surging. And not only are the prices surging, but so many of the materials are in massively short supply, where builders are just struggling to find the ingredients, the materials to build more houses. So this contributes to the price. One of our clients is in the lumber industry, and he shares with me the insider newsletter of the lumber industry. It's called Random Lengths. I guess that means lengths of lumber, right? Like 2x4s. And the average new home price has been increased by about 14% due only to the cost of lumber, not including the cost of the other ingredients of these homes. So very significant issue here, these packaged commodities influencing the prices of the homes. Now, another factor that's been going on that I started talking about back mid-February, a year ago, and I was talking about it before anybody else was, and I was predicting a mass migration out of cities to suburban markets. Daniel, you listen to my podcast, you heard me talking about this 1 year ago before anybody else, at least that I know of, was saying it. And I predicted that there would be a big move out of cities, and that basically came out of what I saw happening in Wuhan, China, and in Italy. Because these are high density areas, and I knew that people would, for safety, want to move and would not want to be involved in mass transit and elevators, the two most dangerous areas. And so people would move to suburban markets, and there would be a resurgence of suburbia. This was something I also predicted actually back in 2012. And the reason I predicted it then was because of the autonomous vehicle, something that, of course, your company is involved in, as other tech companies are. And I used to say location is less meaningful and geography is less meaningful than it's ever been in human history. Because when people work remotely now during the pandemic times, but even before the work remote revolution was going on, it's just been accelerated dramatically because of COVID. The location would just be less and less meaningful. People would not need to live in expensive, high-density cities. Now, add to this the civil unrest, the riots, the looting, the burning down of businesses and so forth, and that's another motivation to move to suburban and even rural markets. So there is a mass migration going on, and you want to position your interest, your life, as much as possible in these more suburban areas. This is where the action is. This is where people are going. So lots of stats on that. I don't need to share them with you. They're on the screen, but you've already heard it now. But that was big news a year ago, okay? And here's one just little research tool you can use. Simply go to the U-Haul website. And this is something I've been talking about for about 16 years now. I originally did this maybe 16 years ago, and I put in renting a truck to go from Irvine, California to Phoenix, or renting a truck to go from Irvine, California to Austin, Texas. And you could see, if you wanted to rent a one-way truck, how expensive it was to leave the expensive market, the market with high taxes, the market that was business unfriendly, and go to the market with low taxes that was more business friendly, where there was more job creation. You could see that this trend was occurring, and it certainly has occurred for many, many years now. But more recently, it's the density that is also another big layer in this equation and in this trend. So here, if you want to rent a truck, now I live in Palm Beach, Florida, and we all know it's no secret that many people are leaving New York City. So if you want to rent a U-Haul truck to go one way, leaving New York City and taking that truck to Palm Beach, Florida, that's expensive. But if you do that and then you reverse the location and flip it, you see that it's very inexpensive to bring that truck back the other way. In fact, many times U-Haul has to pay people to drive their empty trucks back to the markets people are leaving. So this is just kind of an interesting thing that you can do to see where the migration trends are going. I interviewed Meredith Whitney. She's a Wall Street person, but I interviewed her on my podcast many years ago, and that was about 6 years ago now. And she wrote a book called The Fate of the States. And she was talking about how people would leave the expensive, high-tax markets and the business-unfriendly markets and move to the low-tax, business-friendly markets, mostly like the right-to-work states where people didn't have to join a union to get a job, and so on and so forth. And that prediction is certainly coming true, and now it's been accelerated even more. The subtitle note is The New Geography of American Prosperity, which I think is pretty interesting. People are simply voting with their feet, right? And so that's happened. You know, they're leaving my home state where I lived for most of my life, which is California, and they're leaving New York, and they're leaving other high tax, business unfriendly areas. And this chart just shows you kind of where the action is, where people are leaving, and in what numbers. So now let's talk about money, okay? And here's a funny graphic of our Federal Reserve Chairman, Jerome Powell, and he's got his money printer on, and that money printer is working overtime. It's running 24/7, 365. It is absolutely amazing. What is happening right now has never been seen in the history of the country and arguably in the history of the entire world. So, you know, money is not actually printed into existence anymore as it was in the old days. It's partially printed, but it's mostly lent into existence. And an increase in the credit supply, a lowering of the reserve ratio. When the Federal Reserve, our central bank, has now become the biggest investor in the world, where they are buying assets to prop up asset values. It is absolutely unheard of what the Federal Reserve is doing now. Now, you have to think of this from two perspectives. One is monetary policy, and that's what central banks do. So our Federal Reserve is our central bank. Europe has the ECB, the European Central Bank. The Bank of Japan is the Japanese central bank, et cetera, et cetera. So the central banks control monetary policy, but governments control fiscal policy, taxing and spending, right? So these work together in their sort of unholy alliance to do what they do. And by creating all of this new money that has not quite hit the streets yet, but some of it has, a lot more will in the coming months and years, by creating all of this new money, that has wide-ranging effects, of course, on our savings, our stocks, our bonds, our assets, and the value of money itself. Remember, money is a commodity. Really, the more accurate word is currency. And the value of anything is driven by two basic items: scarcity and utility. So if we look around the world and we say, okay, sand, there's all this sand on the beach. Sand is not scarce, and it's also very cheap, right? But it does have utility in concrete. So a lot of sand is used, and actually there are wars over sand, right? But it's still relatively abundant commodity. Diamonds, on the other hand, are very scarce, right? And they do have some industrial utility, but mostly it's for jewelry. So these two factors, scarcity and utility, drive the value of anything in the world, right? So if money becomes abundant, its utility actually declines, because the classic definition of inflation is too many dollars, or whatever currency unit, chasing a limited supply of goods and services. That creates inflation, and we're certainly seeing that now. So scarcity and utility, these two basic value drivers. But our government and our Federal Reserve has made no secret about it, which is very unusual, by the way, because if you look back to our longest Federal Reserve chair, Alan Greenspan, who served for about 20 years, give or take, he used to speak in code. When he would talk, you would have to kind of decode what he was saying, and the markets didn't know what was coming necessarily. Jerome Powell, he's just totally transparent. He's like, look, we're going to keep the money printer going. He didn't say it that way in so many words, but we're going to keep flooding the markets with money, with currency. It doesn't matter. We're not worried about inflation. We do not care. We are going to keep the money going. And unbelievably, this is absolutely a staggering statistic. 37% of all dollars ever created were created in the last year. That, we've just got to all pause and take that in. The Federal Reserve has been around for over 100 years now. They started back in 1913 as the country's central bank, and the amount of money creation is absolutely staggering, to infinity beyond, as Buzz Lightyear would have said, right? There are many measures for money supply. One is called MZM, and you see the graph is a hockey stick. Okay, now look at, and here's the M2 money stock, and just look at this little sliver of the chart and how it goes pretty much straight up the way you would read the chart. It's absolutely shocking, the amount of dollars being created. And this just isn't just for the US. In almost every country, they are creating more currency units with abandon. It's just absolutely staggering. And here is another way to look at it. So, I can show you charts all day, but the real question is, what does this all mean to us? Well, what it means is that there is significant inflationary pressure in the system. And a lot of people say that there hasn't been much inflation yet. And a lot of people will say, they'll try and debunk this argument by saying, look, back in 2007, 2008, 2009, 2010, they were saying the same thing. They created all sorts of new dollars back then, and inflation was relatively moderate. Well, there's a big argument about this, of course, in economic circles, and I would disagree. I think inflation is significantly higher than they are reporting. The government and the central banks want us to believe that inflation is lower than it really is. And they manipulate the most widely used index for inflation, the Consumer Price Index, or CPI, in three basic ways: weighting, substitution, and hedonic indexing. So the Consumer Price Index is just a basket of goods, and it is a metric, a barometer for inflation. And so what they'll do is they'll say, through weighting, they'll give different items in the index different weights to make the inflation rate look lower than it really is. And then they will also substitute things. So, for example, if the price of beef goes way up, they will just assume everybody will switch to chicken. And, maybe you don't like chicken and you think chicken's a dirty bird. And so you don't want to switch to chicken. But that's how they will do substitution. And hedonic indexing, they will do that by saying, and this is especially true in the technology world. So everybody at Intel is certainly familiar with Moore's Law, right, from Gordon Moore. And Moore's Law, which has actually kind of been even modified over the years, right? Look, you're all in the business, so you're the experts. I'm not. But it used to be that the power of the processor doubles every 18 months, right? And so hedonic indexing will say, look, if I bought a computer 18 months ago and it cost $2,000, and I buy that computer today and it still costs $2,000, but the speed of the processor is double what it was, hedonic indexing will assume, wrongly, I believe, that I only paid $1,000 for that computer. Because hedonically indexed, it's twice as good, it's twice as fast. But that's simply not true. In reality, I paid $2,000, okay? And the other problem with this hedonic indexing stuff is that it doesn't entitle us as people to progress. The progress goes to the inflation index. And, if you hedonically index something from the time the electric light bulb was invented or the time the wheel was invented, everything would be free. And it's not free. We have to pay for things even still, right? So these things are ways they use to manipulate things. Now, back in 1971, Richard Nixon took us off the gold standard, and that's when everything changed. The game changed completely. And a lot of people are still playing by the old rules that were the pre-1971 rules. And what happened in 71, by the way, I'll play this video for you. I hope the sound comes through okay. It doesn't always. What I'm going to do is I'm just going to put my microphone next to the speaker, and you should be able to hear it. I'm just going to play a clip of it, not the whole thing, because I want you to hear it from our former president, Richard Nixon's own mouth. Okay, here's what he said, and it's pretty telling.
The third indispensable element in building the new prosperity is closely related to creating new jobs and holding inflation. We must protect the position of the American dollar as a pillar of monetary stability around the world. In the past 7 years, there's been an average of one international monetary crisis every year. Now, who gains from these crises? Not the working man, not the investor, not the real producers of wealth. The gainers are the international money speculators. Because they thrive on crises, they help to create them. In recent weeks, the speculators have been waging an all-out war on the American dollar. The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
So what he did was definitely not in the best interest of the people in the United States. What he did was make inflation happen. And people are still playing by the rules that were the pre-1971 rules, and the rules changed dramatically. So I'm going to show you some ways to take advantage of this change in the rules, okay? And in the interest of time, I'm going to move kind of quickly here. But look, everyone would agree that the government is in a mess, okay? The government has spent far more money than it should have spent on entitlement programs, welfare programs, grants, research projects, whatever, right? Everything under the sun, the government is now involved in it. And this isn't just true of the US government. It's true of pretty much every government, okay? But we're talking about the US because it is the largest economy, and that's where we are for the most part. So 6 ways that the government could get out of the problem it faces, the debt problem it faces. And the unfunded entitlement or unfunded mandate problem that it faces. I've interviewed the economist Professor Lawrence Kutlikoff on my show several times over the years, and he's probably done the most detailed studies on this. And according to him, over the next 15 years or so, the U.S. has about $220 trillion, that's with a T, $220 trillion in unfunded obligations that it simply cannot pay for. So we have to ask ourselves, what will the government do? How will it do this? What is the strategy here? Well, one way it could get out of the problem is it could default. It could institute massive austerity measures, and it could just say to the citizens that, look, hey, sorry, we've spent too much. We can't afford to pay for Social Security. We can't afford to pay for disability. We can't afford to pay for any other government services. We've got to cut back. We've overspent. We just can't do it. Well, this is very unlikely because it's very politically unpopular. Nobody is going to do that. Okay, so that's not going to happen. Well, you could raise taxes. We could eat the rich. Okay, and the reality is this problem is now so large that you can't raise taxes enough to solve the problem. And we know from history that raising taxes curtails economic activity. That's been shown over and over again. So we don't want to curtail activity. We have taxes go up and down. And if you look at a chart over decades, you see that as a percentage of GDP, the tax revenue, regardless of tax policy, is somewhere in the same band. It doesn't change that much. So raise taxes real high, well, the rich go offshore, they find a way to get out of it, or they just reduce economic activity, right? The economy stalls. If you lower taxes, you increase economic activity. And yes, the amount the government collects as a percentage goes down, but there's more activity, so it's a bigger pie to collect from. So that plan isn't going to work. The raising taxes won't solve the problem. We could sell assets, right? We could sell the ports to Dubai. We didn't do that, but that was in the news years ago. We could sell military equipment to foreign countries, even if that's not a necessarily wise idea. We could use the American military to take the assets of other countries. I mean, look, that's what history is made up of, as militaries taking assets from other countries. It's just the way of the world. It's not right, it's not ethical, but it is the way of the world. This is a good thing. This is an optimistic thing. Technological innovation, right? Maybe there will be a technology or many technologies. I mean, we are living in an amazing time right now, and these technologies might solve the problem, right? And there's a big hope for this. There is basically, when you talk about inflation and deflation, there is a war going on, okay? They are butting heads. And on one side, in one corner of the boxing ring, if you will, there is technology. And technology makes things less expensive because it reduces the cost and improves the quality of virtually everything. In the other corner, you've got bad monetary and fiscal policy and printing money and just flooding the system with money, right? And that makes things more expensive in real terms because it reduces the value of our currency. So these two forces are at war. Which one will win? Nobody knows. Nobody knows yet. But the most likely way out of the mess is to simply inflate their way out of the mess. Now, how do they do this? Well, think about it. Let's look at this on an international scale from a geopolitical perspective. If the US owes $1 trillion to China and the inflation rate is 10%, then, and whether that's in 1 year it's 10%, or in 3 years it's 10%, or 5 years, it doesn't matter. That means that after 10% inflation, $100 billion just disappears. Poof. It's magic. It just goes away because we get to pay the debt back in cheaper dollars. And that is a beautiful, beautiful thing. So one of the strategies that I've stressed to people over the years is to simply align our interests with the two most powerful forces the human race has ever known: governments and central banks. And as we do this, we basically follow their business plan. We do what they're doing, and we benefit from it as investors in our own lives. So let's just understand how important this subject of inflation really is. So looking at the screen, to understand inflation, we need to distinguish between real and nominal, okay? Real means what is the real value of something. Nominal means what is the name of something. Now, one of my podcast listeners sent me these a few years back. These are Zimbabwe dollars, okay? And in my hand, I am holding a $10 trillion Zimbabwe note, okay? And here, this is even better. This is 100 trillion Zimbabwe dollars. Now, you can go online and you can buy these for, I don't know, $12 or so in US dollars. And that's because Zimbabwe is one of the countries that has massively debased the value of their currency. In fact, it got so bad in Zimbabwe that they instituted price controls. And the government said, look, if you sell anything, if you're a merchant in Zimbabwe, you are only allowed to raise prices, because they were raising prices hourly. Every hour they would raise the price. And there was no incentive to save money, because everybody thought, look, as soon as I get paid from my job, I want to go spend that money immediately because that's when it's most valuable. If I wait a day, that money will be less valuable. So I don't want to spend it in the future. And I certainly don't want to save money for the future. I don't want to accumulate capital because the capital keeps being debased by inflation, right? So there was an incentive to spend and no incentive to save, which is a very dysfunctional thing. It's not good for society. So what the government did is they said, look, if you're a merchant in Zimbabwe and you raise your prices without our permission, we're going to arrest you and put you in jail. So guess what happened? All the merchants said, well, then we can't afford to be a merchant. We're going to stop selling things. And there were massive shortages. And so this is a very bad scenario, obviously. So real nominal, the difference between price and value. Inflation is the insidious hidden tax. It's a hidden tax that destroys purchasing power. Inflation destroys the value of our savings, our stocks, our bonds, even our equity in real estate, but thankfully the value of our debt. Okay, so how do we align our interest with the most powerful forces the human race has ever known? We use debt as a positive tool to benefit from inflation. Inflation is the most powerful method to redistribute wealth, and it redistributes wealth from lenders to borrowers, because borrowers borrow at the value of today's dollar and pay it back at the value of tomorrow's dollar. I'm going to show you a chart on this in a moment that I think will amaze you. And it redistributes wealth from old people to young people. Why does it do that? It's an intergenerational wealth transfer without inheritance. Okay? It does that because mostly, hopefully, older people have savings and stocks and bonds and equity and real estate, and younger people have debts. So inflation reduces the value of their debt, and it diminishes the value of the older person's savings and their stocks and bonds, right? Okay, I'm not going to have time to show you this video. It's pretty darn good. I have played it on my podcast before and on my YouTube channel, but basically it's just an argument between Peter Schiff and Harvey Hirschhorn, who works for Bank of America. And it kind of points some of this stuff out. If we do have time, I'll circle back to it. But I want to show you this chart because I think this will amaze you. Now, this might sound like it's some esoteric theory, right? It might sound like it's out there in the ether in the distance. It's not. This is something that happened to tens of millions of people in real life. Let me show you. Okay, so there's a lot of numbers on this chart. Don't worry about that. I'm just going to point out a few of them, and you can find this chart on my website. Okay, and I think this slide presentation will be made available to you as well. So if you go back to 1972, 1 year after we went off the gold standard, a median price house was just over $18,000. You can see where my mouse is here. And if you borrowed 80% loan to value on that house, you borrowed just over $14,000. And the interest rate back then was 7.37% on a 3-decade-long 30-year mortgage. So in 1972, when someone bought this house and got this mortgage, $1 was worth $1. And here you have the inflation rate in this column and the value of the dollar as it's getting diminished over time. By 1984, we'll use that year since George Orwell wrote a famous book about it, obviously, 1984, which hopefully all of you have read because it is a lesson for today's world. And he wrote that book in 1948, predicting what 1984 would be like, and maybe it arrived a little late, but we're kind of there now. So read the book. It's very, very good, very prescient. So that dollar was only worth 40 cents 12 years later after inflation. And the people that got this mortgage were paying a mortgage payment of $101 per month. You see where my mouse is? But by 1984, 12 years later, they were still writing the check and it said $101 on it. But the value of that check in real terms after inflation was only $41. So it felt a lot less expensive. It felt a lot more affordable to them 12 years later to pay that mortgage. And maybe you felt this way too about your own mortgage payment on your own house, right? Or maybe your parents did. So by 2001, the last time they made a payment on this mortgage, the dollar was only worth 24 cents. Okay. And that mortgage payment that was $101 was only valued at 24 real dollars. So the mortgage payment got a lot cheaper. So what does this mean? What did this mean to the millions and millions of people who did just this, right? And it doesn't matter. They didn't have to buy it in 1972 and make the last mortgage payment in 2001. They could have done it any time in there since we went off the gold standard and had significant inflation. So sum it all up. They made payments of $36,318 in nominal dollars, in name only. That was the name of them. After inflation came along and devalued those payments over that 30 years, they really only paid $16,393 in real dollars after inflation. So let's sum this up here. Remember, they borrowed $14,614. They repaid $36,000. In real dollars, they really only repaid $16,000 and change. So they thought they were borrowing at 7.37%, but their effective interest rate after inflation was only 1.06%. I'm moving my mouse there so you can see that. And after tax benefits, because remember, the interest on the mortgage was tax deductible, they paid a negative interest rate of negative 1.16%. They got paid to borrow the money. This is the incredible hidden wealth creator with income property. Now, that example I just gave you, okay, and if you want me to just go back so you can look at the numbers again, that example I just gave you was on someone who was an owner-occupant who lived in the house. Just imagine if that was a rental property and they outsourced the repayment obligation, the debt obligation, to somebody called a tenant or a renter, right? They said, look, you pay the mortgage, and in fact, pay me $200 extra, and that's what we call positive cash flow. And they got tax benefits and what I call inflation-induced debt destruction. That's what this beautiful thing is, inflation-induced debt destruction. It's the hidden wealth creator in real estate. Most people think that they got rich in real estate investing because the value of the property went up. And, the value of the property, when you compare it to real inflation, doesn't really go up that much. Real estate is not really that much of a game of appreciation, even though people think it is. Sometimes it is. Maybe it outperforms inflation by a margin, right? But it's not hugely significant. What is hugely significant is the debt going down in value and the fact that we don't even pay our own debts. Our tenants pay our debts for us. And this is one of the beautiful, beautiful hidden wealth creators. So I've got two other videos I can show and share, but I kind of want to leave time for questions. So I don't know what to do. I've got this very nice 5-year plan one of our Silicon Valley clients made about their real estate investments. She made this video. She and her family live in San Jose. And then I've got that other video where they talk about inflation. But Daniel, I want to kind of leave it to you because you're monitoring the chat and there may be a lot of questions I'm happy to answer.
Sure, we can take the video links and put them inside our SharePoint so that people can access them.
Sure.
If you've got questions, make sure to put them in the chat. There's been a lot of interesting chat, but just a few questions actually. And one of the most probably poignant questions here is that in talking about inflation, debt. I'm sorry.
I'll tell you again. I know it's a mouthful. It's okay. Everybody has to repeat this 3 times fast. Inflation-induced debt destruction. It's a mouthful.
So Jess says, it seems like the banks would know this and that they would adjust their mortgages to eliminate this effect.
That is a great point, and you are right. But the reality is the banks don't hold the loans on their portfolio. They sell them off to the secondary market, Fannie Mae and Freddie Mac. And this is a whole big Ponzi scheme. it's the most elaborate, crazy system you could ever imagine. And it takes like a whole career to really understand it. I mean, I have a deep understanding of this stuff, but I don't even fully understand it. Okay. It boils down to many things, not the least of which is called fractional reserve banking or fractional reserve lending. And remember, they borrow the money and then they loan it out at margin. So all they're really watching is their margin. They don't care about the overall rate and inflation, and they're not keeping that loan on the books. And when you study this crazy stuff, this crazy game of economics, you learn this idea that is admittedly hard to get your head around. Through fractional reserve lending, money is lent into existence. That's really mostly how money is created. It's lent. So the banks take our deposits and then they lend at a 10-to-1 ratio. So when we put $100,000 in the bank, they go lend $1 million. And this whole game is money is lent into existence. And just one more point on this that's super interesting. You could research this online, but there is a not famous enough case, a lawsuit that happened in the 60s where a man was being foreclosed on by his bank. And he didn't make the payments, and the bank filed for foreclosure, and he fought the foreclosure. And the crux of his case was the idea that the bank never really lent him the money in the first place. And you know what? He was right, and he won the case because the bank could not prove that they lent him the money, because the money is like lent in quotes out of thin air. It's the whole system is just like this oddly strange, surreal Twilight Zone fake system. It's super elaborate. It's really fascinating. But that's a long answer.
So there's a lot of people that are interested in seeing the correlations between the increases in inflation and, for instance, salaries going up or the growth of the S&P 500.
Yeah.
No specific questions there, but just interested to see charts around these ideas.
Yeah. One of those
you've generated a lot of talk, which is great, and so I'm sifting through it.
Sure. Well, one thing I will say is that it's really sad and really unfair that Americans, for pretty much, I think it was about 40 or 41 years from the late 70s up until about 2 years into the last administration, the Trump administration, Americans hadn't had a real dollar pay increase. So that's why you see this like hollowing out of the middle class and this big wealth gap, because, people who are in the middle and upper middle class, and certainly the wealthy, they own real estate and they own rental properties, and they use this inflation-induced debt destruction to their advantage. But just the poor working person, they cannot get ahead because the real dollar pay increase is just not there. It's terribly unfair, but look, it's the way it is.
So Bo is asking the question, there's a discussion about Fannie Mae and Freddie Mac being privatized again and the ripples it would have on the market. Any thoughts?
Great question. We have talked about this extensively since at least 2011 for the last 10 years. And at first, this would be very, and I'm going to put this in quotes, quote, bad for the housing market, because the U.S. has a very unique marketplace and a very big privilege where since the Great Depression in the 30s, real estate has pretty much been subsidized by the government through Fannie Mae and Freddie Mac, through these pseudo-governmental entities, okay? And the rest of the world doesn't have this. So the U.S. has a very special market. So when you buy properties and you finance them on conventional loans, you are getting a government subsidy. And I say, use it, okay? Take advantage of it. It's a great deal. Around the world, they do not have this benefit. So if Fannie Mae and Freddie Mac are privatized, we will likely see significantly higher interest rates. Oh, don't forget that bold prediction. I got to make that in a minute, okay? We will see significantly higher interest rates, and that will cause downward pressure on prices. That would be bad. But guess what? If the population stays level or increases, which it's projected to increase dramatically, okay, to 350 million people by 2050 in the next 30 years, okay? So big increase in population, stable supply in housing. There's always been a shortage, right? We will see upward pressure on rents. Income property, multidimensional asset class, benefits either way. You just have to adjust your strategy. But likely downward pressure on prices, massive upward pressure on rents because people will not be able to afford to buy and they'll be forced to stay in the renter pool, increasing rental demand. So you ready for the bold prediction? I don't know, you're kind of quiet. So let me make the bold prediction. We have incredibly low interest rates right now. They are artificially low. So here's what I think you're going to start to notice in the next 3 to 5, certainly in the next 10 years. All of these people, tens of millions of people who've been purchasing properties and refinancing properties during this time of historically low interest rates. Do you know they have interest rate charts that go back 5,000 years to Egyptian times? And we have the lowest interest rates now ever in human history. I mean, you know, I'm not looking if they were higher, if they're a little higher than last month. I'm saying basically this era that we're living in, incredibly low interest rates. People that are buying and refinancing houses now, those mortgages cannot be moved to a new property. So they are going to keep these properties. There's going to be a lot of pressure to hold the properties they've got. In the crypto space, in the Bitcoin space, they call this hodling, right? That's like a phrase, a term they invented. And they're going to keep these properties. They're not going to part with them easily. They're not going to sell them easily. So that's going to create a housing shortage. And that means upward pressure on rents and prices. But one trend you're going to see more of, my prediction in the future, is home remodeling and home improvement. So Home Depot and Lowe's will benefit, contractors will benefit, people will be adding rooms to their houses, they'll be improving their houses, but they won't be selling them. And so that's going to create an additional housing shortage, and it's going to create upward pressure on rents and prices because those mortgages are going to be so good, nobody's going to want to give them up in the era we're coming into where rates will have to go up. They cannot stay artificially low like this.
All right, and apparently I was talking on mute when I said, go ahead and make your prediction.
Oh,
I was going to jump back up to Subha's question. This will be the last question.
Sure.
And it's a different topic, is forbearance on mortgages, is that going to cause a bubble or a problem in coming days?
That's another great question. And you know what? A lot of people are talking about it. They're also talking about the foreclosure and eviction moratoriums that are going on. And I don't think it's a huge problem. I don't think it's a concern, but it doesn't outweigh the demand and the low interest rates and the housing shortage and the commodities shortage for building materials. It's an issue. It's something to watch. It's something to think about. It's something to monitor. But again, when people come out of forbearance, all they do is they tack those payments that they missed onto the back of their loan. So it's just not that big of a concern. And it's certainly a less pronounced problem than it was during the Great Recession that we had 13 years ago. So, again, something to monitor, but it doesn't overshadow the massive demand, massive supply shortage, low interest rates, and in real dollars, in real terms, lower mortgage payments than we had 14 years ago. So houses, for all intents and purposes, are cheaper today than they were 14 years ago.
All right, Jason, lots of people enjoyed the talk today. So if you want to see Jason, make sure you go to jasonhartman.com. And thank you so much, Jason, for coming here and speaking to us.
Hey, it's my pleasure. I just want to wish everybody happy investing. There's my contact info. If you have more questions, we're always happy to answer them. And thanks again. Happy investing, everybody. Have a great day.